1,000%. So finding these anomalies, IMP's another one, but finding these anomalies, outside moves. So Big Guns have been working on this. Also, Big Guns have been helping and working on this technology to figure out where there's the potential movers at and which ones are moving the most, have the most upside. Like Ab, that one just kept performing, week over week. So one week there might not be much of anything, but then the next week they're set up and it moved a lot. So keeping track of that and trying to figure out those movers. So again, here has his I've got a pyramid for liquidity. So one thing is inside of Periscope, it's looking at things that have high liquidity and low liquidity. And, you know, so sometimes the low liquidity stuff's not too great. It's like Microsoft, Google, all those always have high liquidity. There's a lot of those contracts traded. And then you have stuff
We
that,
also have this consideration now, Russell. The currently is the Periscope, I guess generating signals at like an intelligent timing, or rather, a round robin processing fashion, as it's currently doing right now, which does kind of like change the performance of how these signals will work in the future.
yeah, having like an impossible time hearing it. Sorry.
No, all right.
I don't know if
How about
everybody
you just
else.
talk? I'll see if I can figure out the input while you're talking. Just let me know when it's
Yeah.
not
It's,
go to
it's,
slide
it's
for
it's
me here.
really quiet here. Um, yeah. So as big gun, I believe I was trying to hear was, these are round robin. So the processing, it's a FIFO order, first in, first out. And the signals are such that it keeps regenerating them over and over and over. And the signals have, like people in the chat were saying, oh, the signals are coupled to the vector. They're not coupled to the vector. Um, all the signals are having to do with it's just the maker ceiling and stuff. The signals are out of context. So while it's showing market maker ceiling and floor, the out of context is a differential between BTOs. So at one moment it picks up a BTO at $1, and the next moment it might be at 30 cents. So that's out of context, and then it may jump back to $1. So as it's processing around robin, it's looking at these different metrics get generated. And ideally, with Periscope, you can either do mixed, which it picks the direction, or you can do bullish or bearish. So, what I was showing, I know this is a first time for a lot of people to see this, so it's like kind of weirdo, but so I keep harping on NASDAQ wave 20 daily because that's only where the entire market's moving. And, Big Gun and I are talking about weeks and weeks ago, maybe 6 weeks back, that we're Ving out, we're washing out, and it's going to start to accelerate to the upside. And we did a triangulation of, using trajectories of where that could be. So you see, we V'd out and then we zoomed up and it closed the first open line in wave 20, and then it's trying to close the next one. I have this streaming in the VC, in that public VC. Knowing that information, you can go over to Periscope and pick bullish because we've just closed that last open line below. And we know, and now everybody's seeing how this works, that we're going to run up and try to close these higher open lines in NASDAQ composite. So knowing that information, you can have a little bit of an edge, a little advantage, because you can go into Periscope and pick bullish, and, get these sometimes crazy, like for example, Harry Builder LDR, and that one moves, 1,000, 1,700, whatever percent. Cat was on a tear. Coin joined the SP 500, but it's the same, just pick bullish. So, you know, knowing the outer scope, which is because the order of precedence is, we have an outer scope, which dictates the overall direction. Then we have an inner scope. Knowing that information helps Periscope because if we know the outer scope, if the bigger picture is long, then Periscope, we can dial it in and pick bullish. And some of these signals it's generating, they'll just, go kind of crazy to the upside. And, I know like people will be missing some of them. I probably need to show more of them in the QQ Live. I know Big Un's been streaming Periscope, but, knowing that we can pick bullish and then, get some crazy moves out of it, some 1,000% plus moves out of that. So it's all in, the outer scope, and then it helps Periscope dial into the inner scope to pick really big potential upsides. So what it does on the deep dive thing, the way it's at right now, seeing like the BTOs, the maximum gain, and letting you know, you can go in there and select them and see, what is performing the best. Because like a BTO, let's say the BTO range between $1 and $2 has historically the best performance. Now keep in mind, we had a 4-week window where our options information was broken. So it's going to impact. We need it to build up history now because that history got impacted by that 4-week window where we didn't have option data. Now we have real time option data. We've bought a massively expensive feed that we're running each month. So the data's coming out Oprah uh, into our system. So it's real time. It's exactly what's being traded at the market at that second. So the only overhead is whatever it takes us to process. 3 minutes. It could be a little less. It could be a little more. The logarithm flexes based on how difficult of a time it's finding a ceiling and the floor. So it again synthetically trades back and forth the chain, the underlying does a million times a day, and it's finding where the market makers feel the volatility is to the upside and the downside, and where the center of that volatility may lie in the PML. So, anyways, that's all real time now. The only delay is processing. So it grabs the real time data and it starts crunching away at it. And let's say the logarithm is having a harder time finding floor or ceiling, it's going to take it longer. So you might see a 4-minute delay, could be a 3-minute delay. So because it has to trade back and forth. Now, a lot of the people, they're talking like Greeks and all this stuff. Well, the Greeks never a fan of them. They're built on European options, and we're in America, so we're not using European options. This guy Burke came along and they tried to get it to American options. But problem with the Greek stuff and Black Scholes, while it helps it helped everybody doing options back in the day. The problem is desire. So some options will trade outside of, you'll see the purple line on POS, which that's the Black Scholes line. Some options will trade below that line, some above the line. You can't figure out that, there's like the formula is kind of okay, but it's kind of incomplete. They couldn't figure out that there's a desire of traders to buy certain things, increasing the premium. So it can't rectify that. There's an adjustment up or down. Like some options, if people aren't too interested in them, they'll trade below the purple line. If people are highly interested in them, they'll trade above what Black Scholes calculates. So to get around all that, what we're doing is Periscope and our systems, we're using and spread monster. We're creating the S wave and spread monster. We're using and that's through the bid and ask. We're using the bid and ask on the Periscope. And what that does is get around the problem of how desirable the options are. So it's taking that into account. So it's taking more variables than Black-Scholes resolves for. It takes that into account using the bid and ask information that's reflected back into that option chain. And that's why at times, it can find stuff. It may calculate something out of 14,000%, may move, 11,000 or whatever, but because it's taking that information into account. So your big gun showing how there's this rate of return based on, where the stock's at. So you can see that. So you can go through the metrics. What I like to do is, when I do the deep dive stuff, I want to get a visual of, what's happening. Like, is it my BTOs of the $1 range working, or is it the BTOs of the $2 range working? Because I want to get an idea how much they're letting these things wash out or not wash out, and then how much that reflects into the future price. Because there's a saying in the options market, like the cheaper the option is, the less desirable it is, and the less likely it is to fail. So this, I can kind of see if the BTOs of $1 are producing, a 500% return. If the BTOs of, $17 are producing, you know, maybe 1,000% return. Kind of want to see that overall landscape. So, there's a little X's to click out things to get a general idea. Because, again, myself, I like automation. I like it up to a certain point. I don't want it all black boxed on me, so I can't figure out what's going on. I don't want it just spitting out a number saying 3. I don't know what 3 means. So I like to see the information it's coming up with, and then I can make a decision whether it's good or bad. But at least I have information on it. And Periscope too, you don't have to, and I use it blindly. I won't just look at Periscope and say, "Oh, it shows 13,000%. This is an automatic win." What I'll do is go in and pull a fractal graph and see where the wave sequence is at. Because to get these upper sides, we've got to break a line of resistance in the fractal graph too. So it's suggesting where things could go, but we know we have lines of resistance. So like on Friday, I was showing Roku. I knew it had great potential upside if it could break that line of resistance. So I think I showed it several times, how we had that line of resistance up there. It's the same thing with Periscope. It's like there's these lines of resistance. We can see them on the fractal graphs. And once we break above them, we start to move into outlier territory. I just refer to them as a monster rally. So we want to see, for Periscope for these signals to kick in, we also want to see breaking on the fractal graph these lines of resistance. And this helps us with, for me at least, it helps with knowing which contracts can kind of have that upside potential. So if I know historically the $1 or 50 cent or $1.75, whatever, seems to have better performance, I know which contracts to gravitate towards. So again, using the market data to reflect on itself, it's not using Black-Scholes, it's not using a calculus or an algebraic formula to resolve. It's showing us factually what's been happening in the past and which ones have performance. Because part of the problem is picking the right contracts too. You can be right on direction and kind of near magnitude, but you pick the wrong contracts and don't really get much performance out of them. So that's always a bummer, you know. So that for me visually, it helps with that. So big intro on the next slide. He's got here that we basically have the watch window. Now, what we don't have is a need to add and it's another core piece of this. But we need to be able to add the out of context signals too, so we can just mask off out of context. That way, we can find, like Big Gun was showing the Goog trade a while, days and days, a couple weeks ago, I guess it was, and it moved massively, right? So we need to be able to mask some of this stuff off. So we need to get that in there to help with finding and isolating some of these things. What I kind of like to do is, like Big Gun showing, is like filtering out for certain signals. That way, it just starts to, um, show things that are more relevant, at least for myself when I'm watching this. So I have screens up that I'm watching fractal data rotating through, so I can see on my screens, like in an instance, I can watch them. Like I'm watching them now. They're moving. They're going through the graphs, the fractal graphs. So I can see where things are at. Like I'm watching EA Sports now, EA Sports Wave 7. So I can see the breakout lines and I can see the target lines. So I already have, when I'm watching that, I already have like, so TOS, you can run on multiple computers, of course. So I'll put in watches on other machines and other windows so I can see that. And then I'll mark where those levels are at for myself. And so using Periscope, it's kind of like the same thing, right? Like if there's something that, when you're watching Microsoft or Avgo or IMP or whatever, and it's showing a particular contract with a particular move. And then, like I said, sometimes I'll do a deep dive and see how those are classically performing at that buy to open level, like, physical dollar area or whatever. And if I like that, I'll put that into a watch window so I can see it in real time. And then I'll put that contract in. And then I can also see where um, a breakout is, a breakout area in the stock. So I'll know a correlation. Now, one thing in the fractal system does address this, just there's a core feature I need to bring over. Right now, like none of the retail systems, none of them combine the option data with the stock data like into the same graph. The correlation between breakout and the option. Because like when I do the QQQ live, I'm kind of drawing in these lines. I'm like, okay, here's resistance. So if we break above resistance, I know that, it's going along or short, whichever way that area is. But a lot of the, like, I'm not aware of any of the retail, and they may exist, but that you can combine the stuff and then create the linkage between the two, the options and the underlying, so that it's calculated on the same screen. So we'll bring that feature over. Now that we have real time, we're starting to get into the real time data feeds that are massively expensive. We can start to hook more and more of that stuff up, which will help give us a little bit more of an edge because we can see everything consolidated. Like right now in QQQ Live, it's not consolidated. We've got the call on top, the put on the bottom, then we've got a 1 minute, 5 minutes, all like a mess. And we're watching, so that's where interlacing comes into another feature. So we're watching disparate things and trying to visually correlate them all together. So the interlacing component in the fractal system starts to address that. And, since we've got real time data feeds again, we can start getting that running real time. And it will help bring everything together to make it easier. So that, and which will help feed into Periscope, the watch window, as things are being spit out. We can put those in, so we can start to more easily see them. But right now, yeah, it's like kind of put them into I just, I just put them into TOS or interactive brokers or whatever, and just be watching them. So Big Gun here has his settings and those upsides, being able to find the Airbnb and the AT&T and JD and That is what it's about here. So, and it looks like on your filter and stuff, the 55 to 60 cent range that had a pretty good upside. So the thing is to stay away from the ones that didn't perform. That's where putting these into a watch window inside of TOS can help. Because if you can't, I found in the past, and I don't know if you check this big gun, but I found in the past doing a 15-minute watch can be really helpful, or doing a 5 minute can be really helpful because it can catch where buyers are starting to outpace the sellers and the contracts. So I think I've showed that a little bit. Right now, I'm showing the one at 5 minute vector on the QQQ Live with just a couple little symbols in there, but mostly that's just to show QQQ as a teaching mechanism, and then people can trade SPX or IWM or anything at all. It's just a teaching thing, how I can kind of figure out levels and mark them in the contract, correlating them, because it's to spare it back to the underlying. But these I haven't really, we used to run the members plays and I would put stuff in, but then I moved that over into a different Discord because they were asking for help over there. So I took it away from us. But if Big Gun starts streaming these this week, then we can keep an eye on those and put them into the whole system. I decided to put the three little windows on the left hand side so I could put some other stocks in there to watch. It's to watch.
I'll keep an eye
I
out
think
this
you're
week.
saying here, Big Gun, oh, you will. Oh, okay.
Yeah,
Awesome.
well,
Yeah, I know people keep asking for you. They're like, "Oh, when's Big Gun gonna start streaming again?" And like, pretty soon.
yeah, as
You're real
you know,
popular.
I appreciate that. As you know, like, it does get a bit taxing to talk on it and also, do it for yourself, but it's like, the kind of like things are getting a lot easier to sort of take now with this live data, so I'll have some more time on my hands in the near future.
Yeah. Yeah, this stuff's totally time consuming. It's all immersive.
Exactly.
It takes so
And this
much time.
setting, I think we were talking in our DMs a little while ago where we're kind of constraining like the BTOs and finding, when do like what constraints on the BTOs are best for kind of like a small account growing, like optimizing growth. And so I did find like removing these low liquidity symbols, not saying they can't make, and also SPX is not a low liquidity symbol, but we just kind of ignore it as being having signals generated every like 2 to 3 minutes, the same time as the rather than once every few hours. Um, but yeah, eliminating these, kind of focusing up on like the highest liquidity symbols as well, um, and also kind of like picking your executions, only trading mixed signals when the price is proximate to the PML and avoiding it when it's more proximate to the ceiling and floor, and also only trading reversion signals when price is proximate to the ceiling and floor. That'll help you a lot on your success. You'll notice, if you kind of like can really peer in there, that some of the lower performance on the mix setting comes when price is kind of either like in the middle of nowhere, where it's like smack dab between the ceiling and the PML or the floor and the PML, or when we're kind of pressed right into the ceiling. And you'll see that the target gain on those also is exceptionally low. So that's kind of something to keep in mind, is that you really do want to be picking your spots and picking your timing. And so Russell's kind of talking about the watch feature. You can use, okay, we have an update, like we can anticipate, an update in whatever stock, right? Kind of at a given time on a given day. And so you can continue watching for changes in that contract as you're anticipating the new update, then kind of adjust with that new ceiling and floor value that gets printed. You see every like 10, 5-ish minutes on this specific watch list that new signals get generated. think we're now moving into the spread monster section, Russell.
Gotcha. Yeah, so we got some updates in Spread Monster now that we've got our data back. Now I've got real-time data. We can start to do more fanciful things. So I've added the when we first started porting code over, just to get the core over running. So now we're starting to add more and more of the bells and whistles. So we've got the check boxes, and you can right click over the check boxes and you can mask out things, and then you can do the bid ask, and you can do the BE. So the break even shows you the contract that is the first mover. And you'll see they will not have consistent pricing. The BE's the one that's in the black background. And if it was consistently priced, it would be at the edge of the option chain here. We show puts and calls, but it's not. It's actually inside the puts and calls. And the way the puts and calls get determined is by volatility. So it's looking at historical volatility and mapping the S waves against that historical volatility. That way we can see outside of what Black Scholes is doing, we can see what the market's actually trying to tell us when we do this, and which is helpful. And then so the imbalance down below has to do with which side it's calculating mathematically. It doesn't mean that it will absolutely go that way, but it's showing mathematically what it's figuring out at that point in time. And you can see the imbalance is to the right side. So the right side is short to the put side. When it puts the imbalance on the left side, it's long to the call side. What that means is when you pull this graph at 4 p.m., and you have 15 minutes on the options to make a decision because they were until 4:15, 4:14:59. So you have 15 minutes to make a decision. So when you pull this graph, like let's say at 4, and you see an imbalance on the short side, for example, that means the expectation through overnight volatility through that 9:30 a.m. open is a short move to the downside. If you see the imbalance on the left side on the call side, that means from 4 p.m. Eastern, when you pull the final values, into the 9:30 a.m. open, overnight volatility is mathematically computed to the long side, call side. Now, anything can happen overnight in these other sessions, so can skew that. So it could compute out to the short side, but by the time we open in the morning, the market could be up. However, this is what it's calculating at that point in time. So if looking to take overnight volatility, like, oh, I'll try in this case, a put, I'll give it a shot overnight at a put because it's showing our imbalances to the short side. And then, see if the put, so that break even tells you which put will respond fastest to a downside move. And it shows you how many points in the downside move you need for that contract to be break even. So that means if you pay an ask of like $1 and it shows a break even of 0.10, market from the close at 4 p.m. to the open at 9:30 needs to move down at least 10 cents. And then that contract, whatever ask you pay $1, for example, will now be that bid will now be at $1 to your break even. So, the more it moves in intervals of 10 or just goes beneath 10 cents, for example, that contract is, puffed up with premium, the more the premium increases. So same way at the call side, like let's say it's 0.20 on the call side. That means above the green line, that green dotted line, which is represented the close, it needs to go up at least 20 cents at 9:30 a.m. to be break even. So if you pay, again, $1 for that QQQ, and let's say the QQQ closed at 450, it needs to be 450 and 20 cents in the morning for that break even to be true. So if you pay that ask, let's say it's the buck, for that bid to be at $1.20, the QQQ needs to go up, to 450.20 from 450 at 9:30. So to have that upside. So that gives a visual of what can happen. And then again, um, so we've added more information to our stats, our array of stats. We've got the open states in there now. Uh, we've got the bid ask average in there. And so you can click them on, because what I kind of like to do is get a visual of stuff. And one way to do it's like in the training videos, Big Gun and Rod, so elegantly put together. You can read these sinusoidal, these S waves, really. You can read those S waves and get an idea where they're kind of flat or they're not kind of flat. And just, you kind of need a bigger monitor because, there can be a lot of them. We can get an idea, the more flat they are, the less likely we are to get in that area. We need an outlier move, which we do get sometimes, but, over the span of 10 years, don't get massive amounts of them, just a few of them. So the flat areas are where the price action is not really anticipated to go to. The market makers, the riders don't feel that through their volatility calculations that we're going to get into that area. So what we do is we map that against historical volatility. So whatever time frame we've picked to see what they're seeing, because they're trying to calculate what the session volatility could be, and we're displaying visually what the session volatility has been. So we kind of pair the two up, and then we do the colorations in the back. The darker the color, the more the price action has moved through that area and stuck inside that area. So it's like it gives us several different layers. Now, the way we've got it, we can click on open states, we can right click over here, and we can mask out areas that the price historically hasn't gone to. Like I like to do a less than or equal to 20% personally, and it shows me where that is. So if I take out where price doesn't go to often, that leaves me with where price goes to more times than not. And I can see that map against our historical volatility. It's in the center. And I can see that mapped against our S waves. And I can see that mapped against our coloration in here. Just to give an idea of, where I can build, like I can put a gray box in there and be like, okay, price action's mostly constrained inside this gray box. What that does is give me an idea of the top and bottom mathematically. Now, when the market starts up, our OMM kicks in, and that's using real-time data. So it starts to calculating factually where that floor ceiling is, but this lets us do it ahead of time in a mathematical model just to get a little bit of an edge on the market participants, because a lot of people don't really have the technology to mask stuff out that way as easily. They're just looking at highs and lows that are on the linear chart to the left. And so here again showing the that we capture and can use. Now these again, these imbalances are just through the overnight and just through the open. Once the market opens, like we go past 9:30, these imbalances will change. So when the market opens, we start trading, then we can switch to the OMM and see what it's coming back with its calculations, where the ceiling is, where the floor is, where the PML. And over the last couple of weeks, we've kind of been consistently rejecting from the ceiling. We had kind of, I think, one day we didn't really do that, but the last couple of weeks we've been rejecting. So, knowing where the OMM is, the ceiling, can be really helpful. You can put side trade relatively cheaply, and then see if it can get hit. And sometimes you can get a couple 100%, sometimes 1,000% out of it plus. But again, these imbalances are just through 9:30. After we get to 9:30, then you cut over to the OMM and see what it is. So this is just from 4 p.m. again to 9:30 a.m. 9:30 a.m. The imbalance is going to change, you know. So it could flip flop. It could be short here, and then when we get into the session and start trading, it could go long. So keep that in mind. Don't be looking at the imbalance and saying, "Oh, it's short," and you're entirely short through the entire session. You're not. It's just through overnight, is what that's showing. And then begin showing the BE stuff again here. Oh, and here's the X's. Okay, so what the X's are, we've got two sets of columns of purple X's. We've got one on the left and one on the right. The X's are the mathematical computation of where the close would be given the fractal system's ability to figure out where the wave pattern's at. That means when we open at 9:30, see on the left side, on the call side, that represents 9:30, the open, these X's. That's been the distribution of open price. And what I like to do is I was showing this, I remember on Thursday or Friday, and it hit just about right on the money. I put in a little purple box there that represented the cluster of X's. And we opened pretty much right at the top and then fell down into the purple box. Now, this one began showing like there's more distribution in it. Sometimes the purple X's are all clustered and they're not up and down the board as much. They're just maybe around the green line, the close. And here they're more spread out up above and down below. So it's a bigger range of open. That means historically we've had more volatility on the open. It's opened way high up, it's opened way down from the green line. Now, using that, let's say there's for argument's sake, 10 X's on the left, 10 different opening prices, and they're scattered way up above and way down below the dotted green line, which is closed. That means running into the next session, if you're taking a stab at a move way up, a move way down, you can see how often they've come in on the open at 9:30. If we got X's way down below, like here, I think we've got two down below. Twice over this many days, we've had an open down there, which isn't a lot. It's very few, but it's possible. And then we've got some X's scattered way up above. And then the X's, of course, we can see mapped against our historical volatility, and we can see mapped against what the implied volatility is on our S waves that the market makers are setting, and we're trying to exploit to see what they're thinking. Really, over time, the open X's, when they're kind of clustered together, grouped, it's going to be within that range. So if putting something on the graph, you can put the clustered tight range there, and then you can put the extremes wherever they're at. Now, on the right-hand side are the closing X's. That means we're estimating where the close is going to be from the 4 p.m. open. So just like we're estimating where the open price action is from 4 p.m., we're estimating where the close action is from 4 p.m. into the next day. There, what begins showing, we've got kind of this cone, right? And we've got a distribution that's kind of equal, fairly distributed between our cone, that big funnel part on the right side. So it's basically telling us the closing price from 4 p.m. and through the next day, since this is just looking at one day ahead, has been within that range. And again, what you can do is you can look at, okay, where's 50% of the price action at? I'll mark that off. So if on that close into the next day, you have an idea of where that close can be in terms of a price range. Sometimes, again, they're tighter. So you have like really high odds it's going to be in a certain area for the close on that particular day. Here are odds, it's just kind of scattered between the two trajectories with the arrow. So, there it's like you can box and go from the top to the bottom and be like, well, this has been my closing range for today. And that may not be very helpful because it's so wide, you can't see any particular price in there that it can land on. It does give you an idea if you're holding contracts that are way above the purple or way below the purple, you're like, wow, those are probably not going to work out. So if they do pop in the day, so you get some premium upside, you can know to exit them because you don't have a high probability of closing in the money on them because it would be outside that purple close range. And again, that's mathematical. So if some event or black swan comes in, like on Friday after close, Moody's downgraded the U.S. to a double A1 from a triple A. And what that means, the U.S. now has a little less favorability on interest rate. So pay a little bit more for the money. The bond market, the treasuries and stuff may look a little more interesting, may pull a little bit more money out of the stock market. We'll have to see what else week, you know, and which isn't too surprising. They downgraded, but it seems like maybe Buffett and some of these other guys had some inside information. They're going to do a downgrade because they were lightening up on SPX stuff. So seems like somebody was leaking some information because there's no way mathematically you could figure out, okay, we're going to have a downgrade, Friday after the close. So, anyways, this helps give some level of guidance for a range. At least it's better than nothing, based on uh, the wave patterns, or based on if you pick the daily, um, you know, stuff. So when we look at the S waves, now we have the option to go to bid or ask. And we should not now have any, there was a issue with the feed, which I fixed. So we should not have any gaps now in our strikes. From Yahoo, we were having gaps. So we shouldn't have any gaps now in our strikes. We would have gaps sometimes. So they should be consistent now. So now we have the capability between bid and ask. Ask is because that shows how much the writers are fearful in a sense that come 9:30 a.m. we could be at that level. So on the S wave, if you look at the tip, the bottom, like I'm looking at the call side, it goes up, rotates down, hooks down, and there's the bottom. That at the bottom where Big Gun has the thing, that means for that open, they do not believe price will be above that point. So they believe it'll be at that point or below. Same thing on the put side. They believe it'll be at that point or above. So where the hook is right there. So that gives a visual. And sometimes it's skewed. Sometimes I've seen this hook right up into the price on the put side, and then I've seen the call way above. When I see that, I'm like, that's almost guaranteed that we're going to have long overnight volatility, that the market's going to open up. And when you see that, if the calls are priced accordingly so that there can be some money made, it's possible to hold them overnight. And so that's something I look for. I think I've sent out a few of them saying, oh, it looks like we're going to have overnight volatility up or overnight volatility down. And that's how I'm figuring it out. I'm just looking at our S waves. And now too, with our X's, we can look at our purple X's and see where the close prices mathematically have been and the open prices have mathematically been. So on the one again showing, I can see we've had more closes above the prior day's close. So you can see that the X's are a little bit out of balance. They're more above. So the market on the close has been had more propensity to be up below the prior day's close price than it has been down, it looks like. And then I can see our coloration, so I can know, okay, we've got risk here because we could get all stuck up in that, all jammed up in this black area right here. I know that's a level of risk we don't absolutely have to break out. And then too, when we look at these convex areas and stuff, we can see that it's suggestive of, and that's our own proprietary data figuring that out. It's suggestive of that can be kind of a peak area throughout. This is one case where you can take it throughout the day. So that can hold sometimes throughout the day. Still need to watch OMM, but you can kind of mark that level just to have an idea. And then as you go up through them, and Big Gun goes through this in his videos, him and Rob put together, you can see how flatlined our um, S waves get as we go up. So, we kind of have the walls up there, and then we have the put side, the call side walls that are forming. And again, information can come into the market to distort that so we can climb into them. We don't have to reject out of them. Maybe something happens today that changes the trajectory, and the market makers, like, we'll see this sometimes, they'll revise the ceiling up. And we know the QQQ is going to start following that up because they're seeing that they've got their volatility calculated wrong. And as they revise up, our ceiling figures that out and it starts revising up. It's like, oh, these guys are like wrong on volatility calculation. So we got to revise our ceiling up. So the synthetic trading revises up, and then QQQ will start chasing it usually. So we know there's more upside in it. And also when they're doing that, that's a potential day for positive exposure. We could like really hit that ceiling and get up into it. And that's +1 or +2 points in value if it makes that move and gets some positive exposure. So when we're seeing the revisions up, we can be like, okay, we may have a positive exposure event. And you can actually get strikes that are, up to 2 times or up to 2 points above the QQQ ceiling. So all this stuff helps, it helps build a structure to the market. So we know what the market makers are thinking in terms of their upside and downsides by looking at these convex areas and our S waves and looking at our colorations that's mapped against that. So one thing we've been doing is we've been showing the NVIDIA trade. That trade, as I was mentioning, we get into it. If we have a black swan, which we kind of did, Moody's came in and downgraded. Have to see how much that weighs on the market. So it puts that trade into peril, having upside. Because if NASDAQ Composite's going to pull back some on this news, that's going to hurt NVIDIA. So, we're looking at it in the 30-cent range, 40-cent range, and kind of had a go time event where it's starting to break out. I think we traded up into the buck 20 range on that July 18th. So now that trade could be damaged because of that information. We'll have to see how the market deals with that. But having a downgrade like that from Moody's, I mean, this whole thing's just, a big video game almost, but is what it is. People pay attention to Moody's or whatever. And we'll have to see how damaging that is. I was hoping in the NASDAQ composite we'd close our 20 daily open line. But we know as we start to get close to that, we can have a rejection, because other traders, institutions are seeing that and they're like, oh, we're going to pull the plug sooner than later. We'll have to see what happens going into next week, this coming week.
One
Um,
question I had for you, Russell. So in your past experience, of several decades of trading, you have seen like a Moody's downgrade before. I think like 2011 or 2014 was the last one. How significant of a headwind does it kind of generally present when this kind of happens?
yeah,
Maybe it's a
they
once in
can,
a decade thing. You know.
you know, those things can be kind of damaging because depending upon how the market takes that information, and if the stock market becomes less interesting, like I think I was mentioning back in 87, 88, 89, I had a money market account over at what was called Marabank in Arizona here. They were paying 14% interest. So I took money out of the stock market during that period. Not all of it. I took some out. I took 10,000 out. I was like 19. I took 10,000 out and I put in Marabank and I get $140 a month. And I think they had it was a money market, but I think there was a lock in. I think they had a 6-month lock in or whatever it was. So it did derail, like it derailed me. I like pulled money out. So if there's a response with interest rates to this and they get elevated, um, people kind of gravitate towards that because it kind of like sure things a lot of people. So that can hurt 2007, 2008 is trading all through that and stuff. And it's like it didn't feel like at the time that it was ever going to clear up. It just seemed like it was dragging on and on and on. And there was always more news coming out about more financial damage to this and that and the other thing. And so I guess it depends on how bad this gets. Is this the only downgrade? Is there some more coming up? I mean, the US is built on credit. A lot of people are paycheck to paycheck. And so I don't know. Moody's downgrading is like no shock. I mean, it's like the whole system's credit based. So, but yet, the market and stuff will do something with that. I don't know. Double A to one is like not that, to me, it's not that big of a deal. I know there's going to be some retaliatory thing with, oh, we got to, weigh in on the interest rate and increase it probably. So that can hurt. And I don't know. And what I've seen this time and time again, when there's bad news, it just seems like there's bad news after bad news. And that's why we get on these waves we see on the fractal system, they'll go down, like maybe wave 20 on the daily. And it's just down, kind of week after week. Because it's like the bad news just keeps rolling in. Comes in waves, it seems. The same with the good news. Seems like it'll come in waves. So we'll get to a point where all the bad news has been absorbed, nothing really else matters that comes in negative. And then any positive event starts to outweigh whatever negative is left. Because, the tariffs right now, a lot of them have been absorbed, and everybody's like, yeah, I've heard that over and over again, tariffs. So now it's turned into credit rating, it seems like. And there's that saying where the cleanest shirt in the dirty pile, I guess. But how this affects the monetary if there was some more downgrades. I know these downgrades are just based on debt load. And I don't know Washington can ever really clear that up. I don't know. The US is just built on heavy debt. So I have to see how long this lasts and if there responds, and the municipal market responds and the coupon goes up, the interest rate goes up on bonds and starts pulling money out of the stock market. And even worse, some of these companies that are kind of in the junk area, that provide valuable services that may be core parts. If they start having to pay more interest, it starts damaging them. So it can cause just a cascade of failure. So hopefully they're not thinking they're going to keep revising this down and they're just going to leave it at this, not cause more systemic problems in the system. Because if they, some of these companies, if they start, some of them are make or break if they get a few interest points on bonds and it will cause them to become a liquid. They just can't service their debt. So if they Moody's dinks around and they're all like, "Oh, we're gonna keep downgrading," or whatever they've got planned or thinking, and it starts hurting real companies underneath the hood that are providing valuable services and stuff, that could be real disruptive. They talk about the supply chain being disruptive, and so all that can cascade into it, hurting these underlying companies. And it I don't know, anybody can guess what's gonna happen. It's difficult because these are always like during the credit crisis, their molecule for dissolution of the CDOs and all that stuff. And they got away from that formula after it melted down. But right now, like I don't know if there's any good formulas to plug into to guesstimate what the outcome is because like it's so hard to dictate the future to estimate the future, so yeah, I it's hard to say if this is going to keep occurring. I know Buffett lightened up and some of the other guys lightened up on exposure to the underlying market, so seems like they're a little fearful this isn't going to end anytime soon. I think if they thought it was a short event they would probably not worry about it and stick it out, but them lightening up. Buffett, they use that thing of how expensive the market is as his index for how expensive NASDAQ is, stock market. I haven't checked it recently, but I know a year ago it was pretty high. So he's always like, when it gets to this upper end, I lighten up and then I let the market fall out. And then when it gets to the lower end of my indicator, I think it's the market valuation to GDP he uses, I believe. So the market in his terms is way overvalued. And I think they've been it looks like de-risking from that event because he's like, concerned that there's going to be a pullback, I guess, of significance. So it doesn't have to be. He could be totally wrong. During 2007, 2008 credit crisis, the recession, he sold a bulk of his portfolio for billions of dollars, and that bet paid off to him. So, dude, they're pretty smart. Him and Charlie Munger, who passed away, always said Charlie Munger was the smartest one out of both of them. But their index for cost of the market against GDP is very high. The market is very expensive. And classically, when it gets up into that level, it pulls back. So, yeah, I don't know. Hard to tell what's going to happen.
I appreciate that insight, Russell. I was also going to say you were kind of mentioning an effect where eventually kind of the market is gets used to like the blows of news, right? Where it gets used to bad news or it gets used to good news. Would you consider us kind of getting towards maybe like the zenith of like how much good news can be absorbed and actually like transmitted into market price?
Yeah, I think so there's a study I read a few years back, 20 years back, and they found mainstream requires so when there's really something super bad, mainstream requires 18 months to absorb it. So they found when there's something super bad, it's an 18-month cycle for mainstream to digest that and then get past it. Like COVID, I don't know where the start of COVID is exactly, January. I was watching in January. when they were building a lot of hospitals over in China. I guess it was due to COVID potential. But then our lockdown kind of started, I guess it was March. There was like a couple months slippage there. So I don't know when COVID exactly started. It was January, is it March, April? So they say, so using that 18-month guide, you take a year and 6 months from whatever that fuzzy start date was. And that's when Main Street starts returning to normal, is what the study found. So I don't know so we had this pullback. I'm looking at the Wave 20 daily. So we had this pullback, weeks ago. We hit that kind of monster wave. It was a 17% move above the pivot. And then it pulled back, consolidated, chopped around, and then it started a big downstroke again, which went over 21% down. So I don't know this news cycle we're in. I mean, did it start during that consolidation phase when we first, and then we started getting under pivot to where we went 21% down using just an 18-month guide? Is that like the first start of it? And are we still within the 18-month window? And we just had this big rally up. So did that end the short window of negativity? And now we're flipped back into positive news flow. It's so hard to say. It's like I knew that we were gonna have a pullback in here somewhere. We haven't, because on the vector, we always move up from the vector, come back down to the purple vector, move up, and we radically moved up. This shows how institutions are also using like fractal type information. They looked at the left hand wave and they just knocked out. They're like, not playing all those days up, knocking it out, trying to go to that symmetrical top. Yeah. So, can you open the wave 20 daily? If
Yeah.
you don't mind?
Do you want me to do it on
Yeah,
the
I can see
Nasdaq
that
Composite?
phenomenon. Yeah, that one right there.
Okay. One minute.
So one thing I like about the fractal data, it's like kind of easy to identify. I need something simple. And so when we were closing these bottom lines, the only thing confusing to me was how many of these we were going to close down below. And Biggin and I were talking about it. We put in the UAT line, and sure as the world, we kind of cycled around it, and eventually we broke away and started the new uptrend. And in Nasdaq Composite institutions, they were knocking out that left hand close. And once we did that, we were marking up the V's on the Nasdaq Composite. We V'd out and started that long move up. So the only confusing thing right now is, are we going to close this open line? If so, that means our long cycle is not yet finished. So the news cycle, I would assume, is going to be bullish or perceived as bullish. So that Moody's thing may be shrugged off. It may have a short term impact. Cycles kind of like back bullish again, or perceived bullish, like any negative news is kind of just absorbed or back bullish. Maybe we do finish closing this open line, so we do have some pullback. And the market, it may try to close this gap up either 50% or the full gap, and then get a bounce. Like what I'm looking for is, if we do get pullback, I'm looking for a bounce of that purple line. And the reason is, when we look back left, we're always bouncing off of it. So that's like a great setup. Go long again. If we can get this purple line, which is 17,541, to come up, and we can get the price action to intersect that line, it's a great setup. So with this, looking at that and equating it to price and everything, we would expect bullish news incoming, to be heavily weighted, and then bearish news incoming to be shrugged off, and to get a bounce in Nasdaq Composite. And with that in mind too, that's where Periscope, we can go into the bullish mode, see what it's spitting out, because you can hit some of those home runs when that event occurs. And it is possible too. I mean, we could hit that vector whenever the time comes, and we could slam through it. So that is possible. But on the left, he kind of pretty rock solid for bouncing. So it could be Buffett and those guys. You know, he could be playing the long game, and some of these other traders, big name traders, they could be playing the long game, looking out maybe 9 months or something. So they're not trying to do what we're doing. Because they have, you know, with billions of dollars, it's different than if you're using 5,000 or 10,000 or 500 into trades, as we can move in and out pretty easily. But when you have millions of dollars into a particular stock or index or billions, you don't really have the luxury to go in and out too easily. It takes time to scale out and scale in. So I think, you know, if we, I don't know. I don't know if we're going to surge forward and close, or if we're going to hook down and intersect vector. It's hard to know what comes first. On the left-hand side, it looks like we hooked down, hit a bounce, and then close vector, or then close the open line. So it looks like on the left, we a lot of times before we close an open line, not always, but a lot of times we have to test the vector for support. And then the market gets a new win and tries to close an open line. So that kind of looks like the behavior. So maybe this Moody's is playing into that a little bit. That's our catalyst for a pullback, and then that clears up. And then we start running bullish again. It'd be great to close these upper lines too, because I'm thinking what happens is people are always skittish. Like, oh my, you know, when we saw this Ving out, no, sorry about that. I was in on a power bar and choking on it. But when we V'd out down here, we could see that, and we could see we were going bullish. And I saw so many discords like, oh my God, you know, the other shoe's gonna drop. And I saw it in the media too. You know, it's like doom and gloom, we're going down, and we're like, no, we're being out. We're gonna try to close some of these upper lines. And, you know, just obeying the analysis, watching it is everything, because that's as best as we can get to a crystal ball. So again, I think probably the news, there may be some short-term bearishness here, but probably the news cycle is gonna be perceived as bullish, and hopefully we close our open line, as Big Gun's mentioning, like what does that mean in price action? So maybe we close this open line, and maybe, you know, we can break out and close the top line, the one right above it. It's kind of a little nebulous, because on the left hand side we can see that we've got, you know, sometimes 3 or 4 tops in a row, kind of symmetrical highs in a row. And then we get these pullbacks, and then finally we close, you know, a higher symmetrical high. So, but hopefully I'm looking at that pullback. I'm hoping it hits the vector, sets up long again, and then we can knock that out, and then we'll have to go from there. But right now, you know, if we get a pullback, so we're not, if we get a pullback, the idea is we're not starting a bear market again. We're not going to get under the pivot. We're going to look for our bounce. That's the first thing we're going to look for, is a bounce off our vector for the NASDAQ composite, and and then try to trade long again. and then try to close that open line above. And then at that point, we'll have to see if we're going to just overshoot or, what'll happen, because maybe we go through that open line and knock out that next one, or maybe we overshoot this open line that's right near us eventually, and then we have a reversion back under the pivot. But I'll have to kind of see, like on the left, there's a case for the two scenarios: closing the open line and surging forward to the next one. I think Trump, if they get this cycle of, tariffs are looking like they're beneficial, and the supply chain's not really messed up. And if the energy costs have been coming down because we got into the $60 barrel oil, that's going to lighten up on the inflation, which will help. Copper doesn't seem like it's caving in, so there's still demand out there. The credit risk thing was not surprising, but I didn't really want it to happen now in the Nvidia trade, so that could weigh in um a little bit. Yeah, so I don't know if I'm answering the question,
I
but
was gonna say one thing, Russell. So we can actually see two sequences here that are kind of showing like the binary setup. This would be your like kind of muted pullback into vector and then continuation to open state. The 72H right here, which comes after the like I guess Volmageddon kind of 2018 correction bottom that we're kind of close to. Um, but we also do have this kind of looming in the background as like a, worst case scenario possibility where we kind of get this like rounded out cycle of short sequences. Like you see, either we get this, your V reversal correction, like 2018, 2020 are these good examples of the V reversal. But 2022, you kind of get like these three big cycles hitting one after the other that ultimately, like from the linear perspective, like drive the market into like a lower leg lower, not necessarily significant, but you see like it just pushes slightly lower every time. Do you think there's kind of like any sort of potential for really like this sort of cycle, like where this is our current 2018 kind of bear market rally ends, and then this is kind of our true low that occurs here, like only marginally like lower, like almost symmetrical with the previous leg that was created. Um,
it,
yeah, that's all I was.
yeah, it could be. I mean, so I think the biggest looming thing, like the tariffs, right? Let's say something really positive is coming out of them, and it helps inflation in the US come down ultimately. At first everybody's like, "Oh my god, we're going into a great recession. Trump's just destroyed the United States." And now that's being played out. As the market goes up, they don't have as much ammo. CNN can't get on there and claim he's the Antichrist. So if that's clearing up, and let's say it's helping with cost in the US, because there's even, I know on the ag side, is, you do the farming stuff, we would send a lot of hay, like from our farm, over into China. The Chinese would actually come out to the farm, check everything out. They check the fields. Oh yeah, we'll buy it. We'll buy it. Buy as much as you can do. And they wouldn't really put any constraints on it. They would kind of pay whatever they needed to get it, their dairies, because they're trying to adopt more of a Western lifestyle, ice cream and all this junk food that's killing us. But so we would send that over. However, with some of the other things, they were not playing fair. Like in Arizona here, like we grow cotton, we grow a lot of cotton, and it cost us 82 cents a pound to grow it. Well, over there, they're like, well, we'll pay you 72. And there's always a deficiency. It makes US go bankrupt farming, trying to grow cotton. And cotton's such a key product, for clothing and stuff. So I totally get what Trump's trying to do. He's trying to force their hand and be like, look, you cannot undervalue the ag was huge things the US was shipping out more than about anything else. I think alfalfa at one point was the number two export for the US. So he's like, look, you can't undervalue it. It's not fair to us. And you can't peg your currency to the US dollar. That's not fair to us. Fully understand what he's trying to do. Getting there is a whole other story. Um, but if he can push there and make things more fair, it's just like they're just not fair. But if he can, that'll help with the cost in the US and it'll ultimately help inflation. And Europe, I know, my wife and I are over there for Christmas for fun. And you don't ever see General Motors, you don't see Ford, you just don't see any of our cars over there. Harley Davidson, they had some motorcycle shops here and there, but by and large, you just don't see anything American, for products like the cars and stuff over there. I totally get he's trying to make it fair. He's like, well, we're buying Land Rover and Mercedes and all this, but yeah, you guys aren't buying Ford trucks or cars or whatever. And some of it is they are large for some of those streets over there, of course. But it's just the markets aren't quite fair, And what the tariffs are, they're a poor man's way to create a minimum wage worldwide. Because when you tariff an incoming product, you're basically trying to create a system where the minimum wage is equal. Like right now, they don't have a universal minimum wage. If they created a universal minimum wage worldwide, that would help because then it comes down to the company, how good at their manufacturing, how good they are at pricing and marketing. They don't do that. They exploit Europe and or exploit, the Asian countries for their labor costs. Same way in the US with our stuff we grow here, expensive growing in Arizona, California, New Mexico, and the Midwest states. Mexico, and it's super cheap. Plus, Mexico allows you to put on pretty much any pesticide or herbicides you need to control things. So it's unfair to us here. We have to obey all these rules and regulations, which drives costs up here in production food. And you walk over to Mexico here, it's 100 something miles away from where we're at. And some of the farmers go down there because of that. And you go down there and the water's like $200 a year for, 50 billion gallons of water you need. And like our farm here, we have constraints. We can only use so much water. So we use 3 billion gallons of water a year, for example, that we pay for. We pay per acre foot, and which is 330,000 gallons. So you pay, $60 for every 330,000 gallons. Well, in Mexico, you walk over there, you pay, 200 to wherever you're at, 200 or $300 a year for as much water as you need. So it's just not, the things are just not fair. I get it. He's trying to make it more fair. And so that, we bring in, nobody wants in Mexico our stuff, our produce or anything we make here because it's so expensive. And we turn it around and bring it in. So he's trying to, you know, make that more fair, which could help. So, and that can help if that clears up. Maybe that'll help us. Maybe it'll run a monster rally. I don't know. We'll see. We've got this huge rally left to center. So maybe the stuff they're doing up there will help that. Moody's isn't helping it, but maybe the underpinnings of what they're doing will help. It's hard to say. Like the US, so Biden, they were passing out money like candy during COVID, and Trump was too when he started COVID, they're on checks and everything else. They're just really pumping a bunch of money into the system. And you get these side effects of huge rallies and stuff because, money's being spent one way or another sooner or later. And I don't know that the US is in a position to keep expanding that. They're talking about the GDP increasing and stuff to help offset the budget deficit, which maybe it will, maybe it won't. But I know I was looking at a report the other day, and consumers are paying more and more of the minimum balances on their credit cards. So it seems like that's more of a signal of distress more than anything. So, have to see how these tariffs play out. I can't discount it. Maybe we are going to run a big rally. So you just kind of have to watch price action because, um, that'll help us in. I think you're drawn big on. We also have uh, these highs on our near term on the right side of the graph. They're kind of coming down a little bit. So it could be an overall indication that our price action's a little bit more soft. One thing I've noticed, and we had this big rally we're coming off of. There's a lot of acceleration of momentum in that rally. And those can kind of be, when we have this monster rally over here, kind of saw the same thing. We have where the price action really accelerated up. It was really aggressive. And we are under that umbrella right now. You just don't know, if we knew 100% that that was going to hold and that was going to be the case, we would all trade all the money out of the market and we would win every time. Nobody could beat us. So we don't know if that's going to continue holding true where this rally has legs. So the easiest way to deal with that is to not go big bets and then kind of limit exposure, not try to break the bank on any single trade. Now, if we do go big rally, that's why I was looking at Nvidia, just because of this, that it was a setup. We had a good setup for it. And hopefully, like Nvidia, we're 30, 40 cents in. Um, and this is a problem with Nvidia, we're kind of getting up to the tops here. And what we like to see is it's got a great pattern, it's got a great setup. We just can't have negative news flow. And if we can keep opening these open states, I went to the top, I went to this, not the very top line, but I went to the 212 area and I'm like, let me aft around that. And the C180 in July. Again, the reason I picked that was because of the NASDAQ setup, potential for maybe the news cycle to clear up and be bullish, hitting farther open states, correlating to our open states. So we've almost knocked out the first 140. I don't, after Friday close, we pulled back after Moody's released that information. So maybe that's a black swan and that comes up the gears, maybe sand in the gears and ruin the move. Let's see if it clears up. If it clears up and we can close this 140 area and head to the next, then it starts to get pretty exciting for a 180. All 180 in July still have potential, but we can't waste a lot of time pulling back. It's got to continue moving forward. So we don't want to see this pull back and test of the vector and stuff. We want to see a surge forward. And the reason I did July 18th was because of when I looked back to the left, we had, like sometimes when we're running rallies, 40 days, 47 days, 30 days to a peak. So I was like, if this thing runs hard, 50 days can possibly work. It's not guaranteed. And also using contracts that were near term, closer to the money, some of them had 800%. So I realized taking the July 18th as it has a higher leverage point, but price has got to react and climb. So taking a little lower leverage point, a little closer to the money, had some big percentage gains over what I was showing on the QQQ Live and box there because it was only like a 300% move or so on that contract so far. But one thing to do is to have more than one contract, have several, and then lighten up as we get to our first close. Goes bad, at least you've got stuff paid for as much as possible. So either you're at near break even or you come out a little bit ahead. 'Cause with a 300% move, 200% move, that means, if you have several contracts, you could sell a couple of them and then pay for everything else. So if it just doesn't work out, at least you've got powder for the next try. Because as I was mentioning 2 weeks ago, NVIDIA, it could take a couple tries. Probably eventually close that 212. May take a couple tries. This may not be the try that works. So we have to keep that in mind that we might need to come back, cycle underneath the pivot, establish a lower high, and then for another setup for a try. Because you're looking at the big guns graph here on NVIDIA, this big monster rally had occurred. We had a deep pullback, and then we had a lesser pullback, and then we had an extension, and then again we had a deeper pullback, extension, lesser pullback, and then an explosive rally move. And that took a long time for a setup. So while we want NVIDIA to work out in our time frame, it may not. It may take, maybe it needs another setup, another pullback, another extension. And because we can see on the left that how that has to work out sometimes, we need several pullbacks in a row for a big extension. So, that could be, this was similar to in Brad's group. I was showing Apple hitting, I don't know, 220, 230, or 212. And same thing, it was same thing as Nvidia. Everybody's like, oh, I don't know if we can get to 200 something. I'm like, well, it shows it can, and it did. It took about a year and a half to get there. And it was, again, it was like the Nvidia, it was a high leverage play. So the thing is with trading is not to get distracted. Some of these, they can take months or a year and a half for a setup. And if one doesn't work, then we have to take the next, and that's the nature of the business. We'll have to see if NVIDIA, we'd like to get a purple bounce off of it. We'd like to close at 140 and then see if we can continue to work towards the next open state in the 170s. I don't know what is in my head.
You do have this at the symmetrical resistance. If we break this projected over to present price has about like 190, like essentially like guaranteed at this little peak right here I'm circling. So that would take us there if we were able to successfully break the macro symmetrical resistance from 2007.
That'd, that'd be awesome because that would give us, if we can get into approaching to 200, get into 200, we've got about a $32 contract on the 180. So, um, at the dollar level, 30 cents, $30 level for 32 is a really big payday. Just if the market can stay glued together long enough to, there's a lot of good stuff with NVIDIA. The biggest thing I think Big Onion and I are talking about weeks back was regulation. We saw that the one thing that could be hurtful to NVIDIA and the AI movement was regulation. And Trump, the Republicans, and this tax and this current big, beautiful bill thing, they're trying to limit that. There's actually a provision in there to stop states from trying to regulate AI. And then he let the lady go at the Copyright Office. So they're trying to block because they know that that's the biggest stumbling block for a so-called AI movement is regulating IP. because if they have lawsuits and they're losing these things, it'll hurt Nvidia so bad because their harvesting of data will be stymied. Like, if they start losing, like if they're harvesting copyright, patents, and then they're reassembling that information, because that's all they do is they collect information, reassemble it, and present it. Try to find, things that are of interest in the data. But if a lot of those lawsuits are coming in and they're losing them, it just kills their business model. So they know that. They've I'm sure all these guys have, they've talked to Trump and whoever will listen to him in the administration and said, look, you guys got to do something for us to not destroy our business. So that's what they've hidden down inside that is the capability for NVIDIA and others in the AI area, Google and stuff, to try to thrive, not be hit with lawsuits and regulations in different states and or copyright infringement, patent infringement. Is that clears the way. That regulation thing I was all talking about, that will help get rid of that and keep it moving forward. So I'll have to see if that passes and if that stays within the bill, because somebody could kick it out. But honestly, I don't know those people in Washington really understand why that's in there. So they may just be like, oh, whatever. I'm not sure that they're that depth into the know of why they put that provision in there and why it's important to some of these AI companies. We know why it is because it will damage their revenue stream and it'll mess up the play we're trying to do on NVIDIA. They probably don't know. Well, Pelosi's husband probably knows, but a lot of them probably don't. Keep it in there and they're not going to reject it, try to toss it out. And that'll clear the path for NVIDIA to make this potential move. As a lot of the other stuff that's going on with NVIDIA is good. You know, Intel's even entering, they've been trying to do the AI thing. Google, everybody's jumping on the bandwagon. So that'll be a lot of influx of cash to help with all this trade.
One
It
thing
looks
I
like
also
from
want.
what
Oh, sorry. Go ahead. Go ahead, Russell.
oh, go ahead.
Oh,
I
I
just
was gonna
understand
say,
your mags.
yeah,
Looks good.
yeah. I was gonna say, basically, kind of regarding Nvidia is kind of like, maybe the figurehead for kind of like a larger market dynamic going on as well. We've kind of referenced this in the past, the magnificent tourniquet, where kind of like value flow into like disproportionate value flow into the Magnificent Seven kind of props up, the market, but also concentrates risk as well. We can kind of see like, I just like look at the Wave One Daily and these like massive, like long extensions on the mags and Qs, and you can actually like very easily see just by comparing that like simple Wave One Daily, like what is actually leading the Qs to like to have these massive moves is magnificent flow. It is the magnificent tourniquet effect going into full force. And so I would say one piece of kind of like if there was an emerging bull market regime for the next couple years, that we would actually see like even more extreme concentration into the magnificent, seven, mag 10, whatever. Like already it's, at like a, it's like encroaching on, concentration levels of 1929. um, like a new emerging bull market would almost certainly kind of see like, a massive increase in that concentration, that tourniquet effect. Even though there is like it's not necessarily like the broad market is failing and only these are performing. It's more so that there's just a massive disproportionate flow into kind of like this magnificent sector here. But the problem is, there's kind of two sides to this coin that we saw originally play out in February with this like pinch setup right here. This is kind of like, personally, like when this pinch broke to the downside, this is where I like, loaded in like a lot of money on, magnificent puts, index puts, kind of. And this is when the beginning of our, correction start almost to the day, like when this broke, February OPEX 220. The minute this broke, this led to our 20% plus correction. Um, and so as, value continues flowing into this and creating like these pinches on the bottom, it still is like opening up this kind of void of like risk, for, there's some bad news regarding one of the magnificents, or just all of them are kind of like, you know, I guess I'm trying to think of a word to say it, like toxic, they're almost toxic in a way that they kind of provide this hole for like a massive indice move to happen if they all start moving in sync to the downside. That's just one
Yeah, and that
consideration.
could very well close that Nasdaq gap and let us return to the vector if we
Absolutely.
get that spill down. So,
Um, but for the
and
plus side for your
it might make sense. Oh, go ahead. I just said it might make sense to look a couple days out at puts
yeah,
that are
absolutely,
down in that area, see what
and
costs they are.
absolutely. And but to the plus side for your benefit for the Nvidia trade, what this is kind of showing is that there's the magnificent tourniquet effect will disproportionately benefit Nvidia if there's kind of just like it's euphoric, like never stops, and we get one of those massive monster rallies like QE rally like COVID. Um, that you would see, I would at least from my expectation, like a continuous concentration into that magnificent sector, which kind of will result in like continued outperformance, of the broad market within like concentrated within those 7, 10 stocks. And Nvidia, I think, will be the leader, of that effect. Like we've shown, kind of like especially like when we saw this correction cycle, like we would see Nvidia actually lead, for example, like this kind of, you see this upside sequence pinching up here again to lead to a further leg down, and this was led sort of by Nvidia. I remember kind of performing the best out of the mags and dragging them all up right into kind of Liberation Day when we pop back down again.
One thing I noticed on the MAGRaph big gun is the macro indicator, which tries to learn the overall trend. We just transitioned green. And another thing I've noticed, and I don't know if this is going to be true this time around, but you know how your cone on the left side here, you know how we kept having, so we had pullbacks and touches to the resistance and pullbacks and touches to resistance. Like, are we going to have a little bit more of that moving forward? Or do we just flip and tumble down, without even trying to touch any more resistance up there? It's like the timing. If we get the timing right, the puts could have some a big impact.
And I do
Percent
think,
I couldn't get.
it comes down a lot as well. Our OMM regime has been, incredibly helpful to the bulls and kind of preventing like any sort of intraday like collapse that typically like precedes like a larger time frame shift to the short side. Kind of like February OPEX, we noticed the shift from hedge prevalent regime to ceiling collapse that like, you know, 20 days later we were 20% lower on the market, right? Those kinds of changes, if we can kind of get ahead of that, are absolutely massive. But there simply has not been like any instance of us really challenging the hedge prevalent regime. The floor has been, if you, I'll like post the OMM in the chat, like you can kind of just visually see like day over day, like the floor crushing up, is like both dampening volatility, which is kind of helping. the bulls and helping us stay afloat, um, but also like kind of grinding us up into the ceiling and also like kind of setting, like some kindling for a positive exposure move long. Um, I can't pull the OMM right now for some reason, but you can kind of just I posted above like that guide we made on like what the regimes are and stuff, and you can kind of see for the last like 2 or 3 weeks, we've been persisting like a hedge prevalent regime almost every single day, and so what that's led to is like the emergence of like a new technical bull market directly from kind of like that intraday regime. I would say like the maintenance of that regime kind of leads to systemic flow into your magnificence, into your blue chips and whatnot. Um, so that's also a big consideration if you're trying to time a downswing move. You cannot fight that hedge prevalent regime. You will get burned.
On your mags graph, it looks like just at a high level, I think that's -3%. It looks like if we do get a -3% pullback, yeah, in that area. But the idea the macro stays green below, it looks like by and large, if we get a red candle down day, red day down under a green, then near the close, it's a decision point to reverse and go with the call side. If the premium's washed out enough, make it worthwhile. So it looks like under a green, if we pull back down to the -3, heading that way, and we close red, then the next day we have the potential to be up. As long as that green macro stays true and stays solid, and then at a certain point in the future we can have a big tumble down. I know what you're saying with this break here on this resistance, on this support, like a tumble. Um, Here we had on your other cone, we had a big tumble down. We went past, I think, -6 or so. But if we stay, and that was when we transitioned red. So underneath the red macro. So if we have the idea we stay green macro, red, then it looks like maybe the market has been to flip and go back green. So I get like a 1L, and then the next day we can have like a 1H event. It looks like under a green macro. Sometimes it's not true. Sometimes I'm lying. Sometimes we get maybe 1, 2, 3 days in a row of red. We don't flip, but something to keep an eye on if we get down into that 3% area, or right
Absolutely.
around the 3% area.
You can really see how the position of how we close like really affects like the next day. When we begin this flush down, and like this period where your red sequences are like massively outweighing the green kind of in length from the pivot, which like that means the market is channeling down. You can see like the initial like close at the low where we just kind of continue pushing like right into the close, a short trend. Those are pretty strong accelerants for next day, 2 day continuation lower. You can see here we go from, 3% to 6% in 2 days. You can see in these kind of other times where we end up closing low here, and it just kind of keeps us in this cycle of longer red sequences than green. The present, we have like this, you can obviously see the massive imbalance as these pinch, right? Massively, the short sequences are getting these massive long sequences that are not pinching at the same rate. They're continuing to maintain this massive length to the pivot. So if you're, as you're saying, that green macro stays, we could potentially see like more of these like massive green sequences kind of pushing up into this resistance, like 4, 5, 6 times, which would like kind of result in like like a pretty substantial continuation from like the current spot price on the Magnificence, your Nvidia probably, gets your 140 plus, if we get like one or two more of these sequences.
Yeah,
So for now, we're gonna start wrapping up and moving into the Q&A. Let me just go back to my other stream. Okay, so moving into the Q&A, I'm looking back at these. Okay, so we want to go through the keystrokes of how to get to the deep dive and also go over IV peak derivation. Periscope deep dive is pretty simple. Select your filter, select your symbol, right click, and you click deep dive. It'll automatically calculate the returns for you over the given period. And then the window kind of pops up. You can maximize, one, two, or, whatever side of the windows you want. Um, you can take out signals from here by clicking on these check boxes, remove the signals. Um, and then we say max BTO, that's our total buy cost of the range. Max gain is a total return. So you subtract the BTO from this, tells you your profit. That hopefully should be good. And then let's see. Okay. The next thing was how am I deriving the IV peaks? So we've changed up the method a little bit on this. Um, you kind of want to use both, and I'll start labeling like bid and ask peaks this week when I do the levels and chart them out fully. But for the ask, uh, and like in terms of the walls, I'm using the ask for this. It'll just give you a slightly like more expansive value. For the peaks, I'm not using these as the peak zones. I'm kind of marking them as a secondary range of interest for market makers. Kind of Russell was talking more in depth earlier about how to use the ask versus the bid. I would say the bid peaks are tried and tested, like working. The peak zones on these are tried and tested working. So kind of continue using that. You will see some alignment with like the peak zone on the bid and kind of your ask peaks. I think it's, if you like say, okay, I don't want to do a lot of work, just do the bid. It's really not going to make like a substantial difference. If you want to get like the best, use of your time and the best resolution, kind of chart these asks as like a secondary level of interest, like a weaker sort of level on your chart. Don't make them like, the subject of the painting or whatever, I guess, for lack of a better term. You'll kind of see that, like, especially in these low vol conditions, these peaks end up kind of being inside our IV wall zone or just about like at it. So there's not really much use of kind of trying to just play reversion back into there is pretty, marginal. Um, for the walls, I think we said we're doing just the ask. That the difference in price between the ask IV levels and the bid IV levels is like extremely marginal. It's like for SPY, it's on an order of a cent. So it really doesn't matter that much. You're not going to see a huge change. What I would more use these for is like if you're having trouble like deciding is this the inner wall, is this the true wall, you can use the ask to kind of second guess yourself and make sure that you're on the right track. Let's see. That should cover the IV stuff. All right, and then we also have a game theory question, kind of general usage on this. So this uses Monte Carlo randomization to find kind of changes, in your account based on certain parameters. You can use the arrow keys, like you click on this and say, okay, maybe I have 35% win rate. You basically can kind of configure, your expected take profit, expected take loss to figure out profitable strategies based on your performance in a trade. And so we'll see. I think my Periscope strategy, like the filter I created, had let's just say 35% win rate, um, average win 150. It's like somewhere in that range. Average loss, maybe like we'll say 50, right? And so you can see, you can also do multiple like line iterations that are telling you like, okay, how does your account perform based on that? You can see that the distribution is primarily like like my account is profitable up here, my account's losing down here. Primarily sees that I would be profiting with the Periscope strategy on these parameters, but I can optimize it to maybe bring that loss down to only 33%, and you can kind of see the massive change in where the distribution is 90% bullish compared to only 70%. I guess bullish means your account's profiting. Um, for confirmation, use the bid to find the IV peak and peak zone. Use the ask for IV walls. Yes, that's basically the gist of it. Like, I'm not saying to discount the ask peak levels. I'm just saying don't use them as like this is the reversion zone. More so use them to kind of properly place your geometric center of the zone that kind of functions as your option implied pivot, also like functionally similar to like what the dead zone is. You'll often see them populate almost exactly on top of each other, which is kind of telling you, something about what that geometric center of the peak zone means. If there's any more kind of questions, can take a few,
You
but we
know,
will. Yep. What's up,
one
Russell?
thing I like to address big on the vector. So the vector in TOS and TradingView is a supporting indicator. It's not the primary indicator. I know everybody's trying to turn it into a primary for trade setups, and and that's fine. You can try to do that, but the way I do it is I use a wave 10-15, and I open up my cycle analysis so I see how we're moving. So, for example, people are like, well, the vector fells in TOS or trading movement, and yes, it does, and yes, it will. If you combine it with cycle analysis, so if the on a wave 10-15, if we're above the pivot, first off, that's long. So we're looking call side. So when we're above the pivot, we're looking call side. And that means when we get call side setups, like we go red to green, those have more weight than the put side going red to green on the put because that's short. Now, something to keep in mind. So on QQQ Live, I'm showing 1 minute, 5 minute. Those are not in phase with the 10 and 15-minute graph because when we come down here and test the vector on a 10 and 15-minute graph, let's say we hold out down there on two candles, two aggregations is what it is. That's 30 minutes in. 30 minutes in can cause the 1 minute to cycle on the put and the call side multiple times because it's 1 minute mapped across 30 here. So if you're trying to get more bias for Fractal into the TOS or into TradingView, you would set your aggregation to 15 minutes. So that way it's more in phase because what's happening is the 10-15 is a bigger phase cycle up and down using a 1 minute and a 5 minute vector like I'm showing. Now on the setup side, so that there's less fake outs, less whipsaws. I was trying to explain this. I think Bilo was asking, like somebody was asking. I was like, oh, it's not a really a primary indicator. On the fractal graph, like on Friday, we were coming down and touching the vector. So that's a call side setup. Now, if you're waiting for your setups, you're looking for your setups, and you're like, okay, Russell is saying I don't really understand it, but he's saying this call side setup. You're looking for on 1015 the price action to come down and test purple vector. That means if it's holding, call side vector is going to start to go green. And sometimes it might be better to put that to match your interval here, to put that on a 15-minute aggregation so that you're more in phase with what you're seeing on the fractal graph. Because if you're pulling back on a 1015 and you're touching purple vector and we look back to the left, we're like, typically we get bounces off of it. 80% of the time we're getting bounces. That means on our 15 minutes, when we go red, us or trading view, we should see an emergence of green with our purple vector holding over here, holding price action. So when we're emerging green, that's a buy-in area. Now you can do the 1 in 5, it's fine. I show it in QQQ live. But just keep in mind those are faster phases, like up and down, up and down, up and down, mapped against a 15-minute aggregation over here, which is a lot slower. So you can get, some put whipsaws, you can get some call whipsaws using the 1 in 5 minute. And then eventually, on the 1015, if it holds the vector, the purple vector, call side emerges green and the call side continues moving forward, moving up, moving long. So, you kind of want to be cognizant that if you're using a 1 and 5, and you do like me, maybe you're just like, okay, I'll copy what Russell does, and he's 10-15. You want to be cognizant that the setup is on the 10 and 15 touch to vector coming back down, or the setup is on a crossover, a pivot. We cross over the pivot long, and then we stay long for many 15-minute aggregations throughout the day and maybe through the next session. So if we're above the pivot or above the vector on the 10 and 15 and we're testing vector, we're looking to call side trades. We're not necessarily, and the puts work. I'll show them in the day, and sometimes you get 50, 100% or more out of them, of course. Is on a reversion back to vector, maybe it's quite a bit of width, maybe it's a couple points, so it allows that put to work. But ultimately, you have to keep straight in your head. Well, we're above pivot, or we may resolve long. So I'm looking for the call side to work. So sometimes ignoring the other side, not trying to go put and call and put and call, like I'm marking in the day, I'm kind of marking those levels, and sometimes they're working both sides, but kind of paying attention to more of the above vector, like Friday, call side was more in play. It was slow, ugly, but we were bouncing off of it. And so the put side, trying to go counter trend, just waste money. You'll sit there and, you know, just burn off trade after trade that's futile, especially like on a Friday where we have more constrained volatility long. And if we're closer to the vector, also, then that means you can get a closer strike. That's another way to look at it too. Oh, you don't want your strike to be too far from that vector here because we're just barely bumbling along it. So not getting a lot of upside out of higher strikes. So that's how, and I know Arsenio, which is totally valid, he's playing the vector moves, which you can do. You just, it's just easier to try to keep with the fractal data. The fractal data is used for the vector and TOS and trading view. That's where those come from. So they're a paired indicator. Fractal data, long or short, goes into which side you're looking at on TOS or trading view to give a little bit more of an edge in direction. And then using open states too for targets above or targets below. So wanted to clear that up. Sorry, Big Gun, I didn't mean to interrupt us.
Oh, no worries at all, Russell. Thank you for clearing that up. We had another question regarding usage of the call and put walls. How often they change intraday, the source is the source CBOE live data, and how like does the way it's actionable change throughout the day?
Was that for me?
Yeah,
Were you
yes,
answering
yeah,
that?
I was gonna just say, the only piece I had really is that, the main way I use it is I just look for kind of like the ledges to estimate as we pass over their exposure points, changes in the OMM volume lines. You can use that to anticipate changes in the OMM volume lines. So that's kind of how we say like, oh, if we break above, the 520 strike, we're going to passively continue long. That's just using the same properties the OMM is showing. But if you could answer, that would be very helpful, Russell.
Yeah, so, when Big Gun's mapping this stuff out, and you have to remember, so when Big Gun maps it out, it's beforehand, right? And we're using what the writers believe at that point in time is their volatility. So Big Gun's mapping the levels out, long and short, volatility. So as we're trading, there's always new information coming into the system. So as we're trading, news events are happening, Trump's tweeting, that can cause that volatility envelope. So Big Gun identifies a volatility envelope for everybody, and then you can copy and kind of implement the way he does it if you want, or take pieces of it. So he develops that volatility envelope, and that is expectation for that session. It because I'll see sometimes people be like, "Oh my God, we got into the IV wall and it just kept going up. It doesn't work right, or whatever." It's not true. It's just that the writers themselves, they're not perfect. We don't trade perfectly. Their models, and there's several models they use to price options, but their models were off. They did not account for the volatility. And the price, it just seeks out that level. And through the OMM, we see that they're adjusting through the ceiling, seeing that they know they're wrong. They've got to recalculate. They've got to try to stay neutral so that they're not losing money. So these models Big Gun does beforehand, which is important because a lot of times they hold rock solid. We'll have periods where, they're flawless for weeks. But then maybe we get a really big volatility event and the market itself's wrong. If the market's always right at pricing options, we would never win trading them directionally because they would always price them such that we could never get an advantage, a little bit of an edge. And so for that edge, for us to acquire that edge to where we can have an option go, 500, 1,000, 2,000%, something radical. That by definition means we have to, those levels that Big Guns identify that our system's showing, we have to encroach on them and get into them, get above them, get below them. So we have to have that outlier day break through. Now, by and large, the institutions that are writing a lot of these contracts, they don't want to be wrong. So they'll do a lot of things to implement to help dial in their volatility metrics. So, anyways, so by our kind of novel approach doing our S waves and stuff, we can visually see the volatility that they're mapping out, that they're believing is true at that point in time. So you have to keep in mind when Big Gun's marking up or you're marking